Hey there, everyone. Welcome to the Final Barts Monday, July 22nd, and I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the tools of the Stockcharts platform, tools designed to empower active investors, self-directed investors, money managers, financial advisors, anyone in between, to make better decisions by having the right evidence to make those decisions. And we would argue that having a good sense of market supply and demand, fear and greed, all of the sentiment shifts that cause prices to move up and down. That's the game. And while we can pay attention to macro drivers, the Fed, economic data, all of those things, certainly going to be coming up through the course of this week. Price action is most important. Price is king, as one of my mentors, Ralph Acampora, always liked to say. With that in mind, let's get right to our market recap and see how the market's played out here. Decent update, really, with some of the traditional growth sectors that had been struggling last week, actually having a nice rebound move to the upside. I think the question is for things like technology, some of the semiconductors that had such a great day today. Is that sustainable, right? Is that a reaction, a counter trend move back higher after the deterioration that we observed through the course of last week? Or is this the recovery, the move higher? I think through the course of this week, particularly with so much earnings on the calendar, we'll probably find out. End of the day, S&P 500 finished around 5564. That's up about 1.1% from Friday's close. The NASDAQ Composite finishing up about 1.6%. Slightly higher than the S&P 600 small cap index, which is up 1.5%. The VIX actually moving just below 15. Now, the VIX, which had pushed quite higher the end of last week, as a matter of fact, Friday, the VIX actually briefly went above 17, which is the highest we've seen in quite some time. VIX actually coming back down today, finishing the day just below 15. That 15 level is usually our cutoff. A VIX over 15 is a sign of a confirmed pullback. Usually means that fear and uncertainty is escalated. That usually is coinciding with deterioration, which is why I'm tending to think that a day like today is more of a mean reversion move after the sell-off that we saw last week. But let's keep an eye on that 15 level. We're literally right there. See if the VIX is able to get back above there or remain below. And I think that'll tell us quite a bit. In terms of other asset classes here, to zoom in a little bit, you can see interest rates slightly higher from Friday's close. The 10-year yield finishing today just above 4.25. The long bond yield just slightly below 4.5%. Of course, the next Fed meeting, that is, will be next week. And interesting to see how the market moves in anticipation of a potential first rate cut, and think about what that might mean. Certainly the market is pricing in, I would argue, pricing in kind of those lower rates. And certainly when you look at something like home builders, which have had a really decent July, part of that, I would, in no small part, if not the most of the thesis, is lower rates makes homes more affordable. So we'll keep an eye on those metrics. Bond prices slightly lower. The TLT was down about 0.33%. Dollar index, no real change from Friday's close. Looking at the commodity space, you can see gold, while down for most of the day, actually finished just slightly above zero. So nice recovery in the afternoon after a pretty weak morning. Earlier in the morning, a lot of the commodities were a lot deeper red, and it looked like things were going to get really concerning really quick. They had a nice improvement through the course of the day after the lower open. Crude oil, copper prices still, however, down from Friday's close. Cryptocurrencies, excuse me. Cryptocurrencies just continue to be a key story, right? And volatility remains the story. Bitcoin just going into today, right? Over the weekend, Saturday into Sunday, down in the low 60,000s. Yesterday we were down in the 63, 64,000 range as I was flying back from Boston. And today you see cryptocurrencies actually rolling higher through the course of the equity trading session, currently just above 68,000 to 68,125. And that's literally where we started the clock here for the official Monday trading session or unofficial Monday trading session, that is, for Bitcoin. Looking over at the 11 S&P sectors, you can see its growth at the top. The XLK, which is the technology sector, up 2.4%. That's your best performer by far. A lot of semiconductors, of course, did quite well today, and there's a lot of market cap represented. There are certainly some of the biggest weights in the technology sector. Consumer discretionary, number 2, and industrials, number 3, both up just over 1%. On the downside, only one of the S&P sectors finished in the red. That's the energy sector, down 0.6%. Consumer staples and materials moved slightly higher from Friday's close. Our market trend model, we formally update every Friday after the close, and it's worth noting that as of last Friday's close, the short-term model actually on the S&P 500, which is my main market trend model, actually turned bearish. Now today, we've moved right back above that bearish level, but we don't update the model again until next Friday. So my official model says short-term bearish, medium-term, and long-term bullish. The last time we had the short-term model turn bearish was at the April pullback for the S&P 500. Now, the NASDAQ 100's trend model has been negative now for a couple weeks, so the S&P kind of joining that weakness that we've observed there. Looking at the Magnificent Seven and friends, as I like to call them, we had Tesla and NVIDIA both up about 5% of the day. That's a nice recovery after a weak last week. I mean, last week was a tough one for a lot of the Magnificent Seven names. It was all about the rotation to other areas of the market. Tesla and NVIDIA having a nice bounce. Now, what's interesting is the charts don't look particularly strong yet on that medium-term time frame or any stronger than they did on Friday. This is sort of a bounce higher after a lot of deterioration last week, but a lot more to come. Tesla, of course, is one of the two Magnificent Seven names reporting earnings this week, so that's something to keep an eye on. Apple and Amazon actually both slightly below zero as we wrap today's trading. Let's go to a daily chart of the S&P 500 and see how today's pop higher fits into this overall trajectory. And what you'll see on my chart of the S&P 500 is that we remain above what I wrote on social media earlier called the trend line to rule them all. This pink trend line really connects the major lows over the last 10 months. We take the October 23 low, we line that up with the April 23 low, and that lines up very, very well with another low in April, a low in early May, a low in late May, and not too far below Friday's low. We didn't quite get down to this trendline support before bouncing higher today, but last week, as you can see, we had a gap lower on Wednesday, then Thursday and Friday continuing to trade lower through the course of the day, not enough to get below that trendline support. That's why I find trend lines to be so helpful, and this is where I find trend lines can add great value in terms of just assessing the risk in the markets, right? When you draw a line like that, what you're basically saying is, I'm assuming that if the trend remains above that level, on a log scale chart, a straight line is going to have a consistent percentage slope. That's how the math works out. So as long as the S&P continues in a similar pace of trend, meaning a certain average percent returned over an average week, then we're going to remain above that trend line. That's why we're waiting for a break below that trend line, which would tell you that something's different, right? Instead of continuing in a pattern of higher highs and higher lows, we're actually rotating lower. Until that happens, this is still kind of fine. And so I would say with today's bounce, it's just a reminder that while we have seen some short-term weakness, and I don't think, to be honest with you, that the weakness is done, I would say even though July is remarkably strong on average over the last 10, 15 years, August and September are the weakest 2-month period of the 12, and we're almost there, right? So I think expecting some further weakness into August and September is a very reasonable expectation. Expecting that trend line to eventually break, I think, is totally fair. Looking at the 50-day moving average as a next level of potential support, just about 5,400. Looking for further support levels down on this chart, and that's why I highlight and update these sort of levels to pay attention to. The S&P above 5,400 is still a pretty decent chart. S&P getting below 5,400 would mean we have broken that trend line in pink that I mentioned before. We've broken the 50-day moving average. That would also mean we have broken the gap higher from early June. If those three things are broken, it's hard to think of this as a still bullish market, but that's where we're at today. So again, I think a chart like this is innocent until proven guilty. I think the trend is still fine. The momentum is still above average with the RSI consistently above 50, but I'm actively looking to see it when, not if, but when that trend breaks. And the seasonality would tell me August is probably the time to expect that sort of breakdown. Now, when we look at breadth indicators, you will see that things aren't that bad yet, right? I mean, the McClellan Oscillator, while not updated for Monday's close just yet, this is as of Friday's close, but with all the deterioration that we saw last week, and I would expect this to move slightly higher today given the advanced decline data that I've reviewed, but overall, I would expect that the McClellan Oscillator is still above zero, which means even the short-term breadth conditions are still okay, right? You're looking for a change or a break in that pattern, and I would say for now, the short-term breadth is still fairly constructive. Stocks, while they've certainly been pulling back, particularly the big growth names, most stocks are still above their 50-day moving average. And most stocks, and this is in the S&P 500, were made above their 200-day moving averages as well, just like the S&P. So get concerned when that 50-day number starts to break. The last time we broke below the 50% level after being above it for a while was at the April pullback, right? And so I think we've not seen that similar sort of deterioration in breadth conditions, even that we saw back in the April pullback. Now, the VIX through last Friday actually got to around 1650 on an intraday basis. It did push slightly above 17 during the trading day on Friday, finished the week around 16 and a half. Today, just slightly below 15 at 14.9. I think this could be a key thing to watch. We've pulled back a little bit as the market settled down after the deterioration in the second half of last week. Can we hold a VIX below 15? And if it looks more like this in November and December of last year, it looks more like this in February, March, looks more like this in May and June, that means most likely the market is in a stable footing and making upside progress. So certainly something to pay attention to. I highlighted for my market misbehavior premium members one interesting comparison to make. Over the last couple of weeks, and this is just the current week, this is a placeholder until we get the current survey data from the AAII, and that'll be on Thursday that we can report that. But if you look at the 3 prior weeks, you can see that over the last couple of weeks, we've had an increase in the number of bulls. As of last Thursday's reading, it was right around 53% bullish, and that's over double the number of bears, which was around 23%. So, a big spread between bulls versus bears, but keep an eye on that increase in bullishness from retail investors that participate in the AAII survey and compare that to the name exposure index, which are money managers, right? These are people that manage other people's money, most likely not just their own. You can see a decline in the name exposure index over the last couple of weeks. So this means money managers are actually dialing down their allocation to equities. Still a decent allocation at 88%, but not as high at 105% that it was at the end of June. So over the last couple weeks in the month of July, you've seen money managers selling this strength and you've seen retail investors buying this strength. I think that could be an interesting juxtaposition. One of those groups is wrong, right? Either this is a really buyable dip and we're super smart buying additional strength, or the name exposure index is more appropriate, saying that we should be selling into this strength and getting defensive going into August and September. I would tend to subscribe to that way of thinking given the seasonal tendencies. But however, price is what's most important for now. Trend's still positive. Let's go to some individual names and see how they played out here to round out our show today. I do want to start with Truist, which is one of the regional banks that we follow. The KRE is another great way to just track the regional banking space. Overall, these stocks have done pretty well here, particularly in the last 4 weeks or so. Coming out of mid-June to mid-July, you can see Truist bounced off of support around 35, pushed higher to make a new 52-week high, finished the day today up over 3%, just below $44 a share. But I like that trend of higher highs and higher lows off of that June swing low. We can see we're overbought here, which doesn't concern me a ton just yet. Tells me that overall the trend is pretty strong, and I'd be looking to see what sort of higher low we may be able to establish here very soon. Truist and other regional banks are key to watch because they're very dependent on interest rates. A lot of these are in the mid cap and certainly some of them in the small cap space. So when I do a webcast tomorrow on Wednesday of this week talking about small cap performance, regional banks will most likely come up. By the way, if you're interested in that special event, you can go to marketmisbehavior.com/small caps. We will be talking about small cap performance here in late July. Talk about this potential rotation because the IWM has broken out, the Russell 2000 ETF, in a way that we haven't seen in quite some time. We'll talk about large versus small, the over allocation a lot of investors have to mega cap growth, the under allocation you probably have to small caps, what factors might improve or impact the valuations of small caps, and where some opportunities might be. We'll look at some stocks and some certainly some ETFs as well. So go to marketmisbehavior.com/small caps to sign up for that free event coming up this Wednesday at 1 p.m. Eastern. Continuing on here, of course, Tesla, one of the earnings names of this week. Truist, by the way, just reported before the open today. I believe Tesla's coming later this week. They're actually reporting tomorrow. And if you look at the chart of Tesla, I would probably label this as a pennant pattern. We'll zoom into like the last year maybe to see that. Yes, so a pennant pattern is where you have a big move higher, which you actually call the flagpole, and then you have this sort of short-term consolidation pattern of lower highs and higher lows, right? So big move higher and then a consolidation. What this is telling you is that the market's sort of in an equilibrium. Market's telling you the stock's worth around $245 a share. We either are going to break above the upper boundary, which is most common in a pennant pattern. This is usually thought of as a continuation pattern, meaning whatever trend was happening leading into this move, you probably consolidate for a bit. It's a placeholder or a pause before you continue. You hit play and ride this higher. And the general measurement is to take the strength of the move going into the pattern, project that off of the high, and that's, or out of the breakout level, that is, and that's your projection for a minimum upside target. That's the general way that Edwards and McGee, who literally wrote the book on price patterns in the mid-1900s, that's how they described the pennant pattern. I would keep an eye on Tesla. Earnings tomorrow could certainly pop this stock above that upper boundary and or pull it back and drop it lower, at which point I would be laser focused on the 200-day moving average, also the swing high in February, right around $200 a share. That seems to be an important level. I mentioned the strength in some of the semiconductors, so I want to highlight NVIDIA having a nice up day around 5% higher. What's interesting is that comes after last week where we sold off and tested an ascending 50-day moving average. I'm going to zoom into the last year just to show that pattern here, right? So we had the gap lower on Wednesday, but really didn't go any further down than that gap. We had a couple down closes, but they held that 115 level, and from there we've actually bounced higher a little bit today. So NVIDIA, for now, holding an ascending 50-day moving average. That's actually super encouraging as the RSI is holding above 40. For now, this is more of a buy on the dips type of a chart. We break below here. We break below the June swing low. This chart looks really ugly really quickly, but for now, kind of holding up there. Applied Materials, there are a lot of semiconductors, of course, we could watch. Now, AMAT has actually already broken its 50-day, but it's holding at 210. Now, 210 is an important level because that was resistance in March and April. We broke above there in May and retested it. Now we are testing support again. So that is a technical concept called polarity, where resistance becomes support and vice versa. This chart above 210 is still a good chart. This chart below 210, I think, very questionable. The next downside level would be about 185, 190. That's the April swing low and the 200-day moving average. So keep an eye there. Things that are not working. Verizon also in earnings day today. AT&T also in a sympathy move down as well. The chart of Verizon has come down a little bit. I'm going to take the unadjusted chart. So I'm going to put the underscore below in front of the ticker. Because it's such a higher yielding name, I like to look at the unadjusted data because it's the actual prices where this stock traded, adjusted for splits, of course, but that's kind of the level. When you unadjust the data, you can see as of today, we're right down at the 200-day moving average. We're also right at key support. So while the stock gapped lower on earnings, it's kind of right at the point where if this thing's going to hold, this is kind of the place where it should, because if you break it, there's not a lot of potential support levels until you get down into like the mid 30s, low 30s. That's a long way below current levels. So while the dividend yield is attractive, the price deterioration is a big concern if we confirm a close below the 200-day moving average. Has not happened yet, but something to watch. CrowdStrike, of course, the name, the technology company that everyone loves to hate after last week's deterioration. And thanks, some of you, for your concern. I had no issues. I traveled back and forth to Boston last week. Thankfully, had no issues with flights and or rental cars. I was able to get around New England just fine. But boy, I was concerned. I actually got the headline after I landed after I was at the hotel in Boston and saw that had happened. So my sympathies, because that's tough when it's out of your hands and you're caught in some city. But CrowdStrike, of course, really taking some damage today, down another 13.5%. And that's after Friday's gap lower. So the news kind of broke here. We gapped down to the 200-day moving average, and that was the interesting question for me: was would that hold? Today, the answer is a big time no. It sounds like investors will be punishing CrowdStrike for beyond just the end of last week. This is going to be a chronic issue. Chart like this for me, now that it's below the 200-day, now that it's below price support, now that the RSI is so low, this is the kind of thing I consider guilty until proven innocent. Now, instead of looking for a buyable dip, you're just looking for signs of accumulation. You're looking for signs that this deterioration is starting to dissipate, and I'm not seeing that on today's trading at all. Couple stocks reporting after the close today to keep an eye on. By the way, Cleveland Cliffs, which is a steel company, NUE, which is in that same space as WAY. Both of these have Both of these have bounced off of a swing low in the last month or two, and to look to see if it can regain momentum above moving average support. Something like Nucor has broken above trendline resistance, so that's encouraging. Look to see if we can make a higher low. I think still there's a little bit to prove here. Only one key technology name to watch for me, and that's Logitech. Nice move higher today, right above the 200-day moving average. Can that hold if there's some disappointment on the earnings side? Folks, that's a wrap for today. I want to thank you so much for joining us every weekday after the close for the final bar. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.